Ever wonder what really goes on behind the curtain when a big company announces it's being bought? It's way more than just a press release.
Oh, absolutely. It's a whole story, really,
Hmm.
often told through numbers, strategy shifts, and sometimes, well, dramatically changing priorities.
Totally. And today, that's exactly what we're doing. We're taking a deep dive into the latest financial results from thtx, a biopharma company,
Right.
and specifically what these numbers mean now that some really huge news just broke about them being acquired.
And what's fascinating here, I think, is how those financial figures, they really paint a picture, especially when you line them up next to a massive event like a company acquisition.
Hmm.
So our mission for this deep dive is basically to pull out the critical insights from their Q2 2025 report and that acquisition announcement. We want to connect the dots, link the financials to the big strategic moves.
And for you listening, the benefit here is pretty significant. You'll get a quick but really solid understanding of what drives financial performance in a situation like this, which is super dynamic.
Yeah.
And maybe more importantly, you'll learn what specific signals to actually look for when a company is, on the verge of being acquired.
Okay.
All right, let's jump straight into the bombshell news then. This definitely shaped the results we're looking at. The AV Technologies is being acquired by an affiliate of FuturePak.
That's the one. And it came after the quarter ended, which is, like you said, a really crucial timing point.
So how did this looming deal, how did it influence their recent performance? And what did it signal right away to investors?
Well, the most immediate tangible consequence was that the company withdrew its fiscal 2025 guidance for revenue and adjusted EBITDA.
Right. Adjusted EBITDA, maybe just quickly remind us what that really tells us.
Sure. So adjusted EBITDA, it's basically a measure of a company's core operational profitability. Think of it as the cash generated from the main business before you factor in things like interest, taxes, depreciation, amortization, and other sort of one-off adjustments.
Got it. So pulling that guidance.
Yeah, pulling that guidance because of an acquisition isn't just a formality, it's a massive signal. It basically says, look, the future under new ownership, it's going to be so different that our old projections are basically meaningless now.
Okay.
For investors, it's like hitting a reset button, right? You're not valuing the company on its old path anymore, but on what the new owner might do.
Makes sense. So if that's the future outlook, let's look at the actual performance before that announcement really took hold. The Edrec Technologies reported total revenue of $17.7 million for Q2 2025 and $36.8 million for the first half. How do those numbers stack up?
Well, the top-line revenue actually saw some noticeable decreases year over year. We're talking a 19.5% drop for Q2.
Oh.
Yeah, and a 3.9% decline for the first half of fiscal 2025 compared to the same time last year. So that immediately flags, a bit of a challenge for their main business during this period.
Okay, so a dip overall. What about their key products then? Egrifta SV and Trogarzo. Did they both face similar issues, or do they have different stories?
Egrifta SV definitely saw a significant drop. Net sales were down 31.3% in Q2, bringing in about $11.1 million.
Wow.
And down 3.0% in the first half, which was about $25 million. Now, there are kind of two big reasons for this.
Okay.
First, remember that supply disruption they announced late last year? That directly led to lower unit sales. They were down almost 25% in Q2 and over 6% in the first half. You just can't sell what you don't have, right?
Right, the supply constraint.
Exactly. And second, higher government chargebacks, rebates, other adjustments. Think of these like mandatory discounts. This was mainly because of new rules from the Inflation Reduction Act, the IRA.
Ah, okay. The IRA impact kicking in.
Precisely. It brought in new rebates for Medicare patients late in 2024, and that hit their net sales figures pretty hard, down over 11% in Q2 from that effect alone, and about 2.4% in the first half.
So a double whammy then. Supply issues and new government regulations hitting Egrifta SV. That's tough.
Yeah, it really was. The only thing pushing the other way slightly was a higher selling price, which was up about 5% in Q2 and 5.6% in the first half, but clearly not enough to offset those two big hits.
Okay, so after hearing about Egrifta SV's struggles, I'm really curious now. Did Trogarzo, their other main product, fare any better, or did it follow a, similar downward path?
Not quite the same, actually. Trogarzo net sales were actually up 13.4% in Q2 2025, reached about $6.6 million.
Oh, okay. Interesting.
Yeah, and that was mostly driven by higher unit sales, up 11%, and also a slightly higher selling price, up 3%. Government rebates were pretty stable in the quarter for Trogarzo.
Well, I sense a but coming.
Well, yeah. For the full 6-month period, Trogarzo sales actually decreased by 5.7%, down to about $11.8 million.
Ah, okay. So Q2, good. First half, not so much. Why the difference?
For the 6 months, it was mainly lower unit sales overall, down 4.1%, and also higher government rebates, hitting them over that longer period, down 4.7%.
Why?
Again, that higher average selling price helped a bit, up 3.1%, but not enough to counter the other factors over the full 6 months.
That's quite a contrast then, up in the quarter, but down year to date for Trogarzo. Now, the CEO, Paul Levesque, he sounded pretty optimistic when he talked about these numbers, despite the revenue dips. What did he point to regarding demand and the future? Is that optimism justified, or is it maybe, putting a brave face on things before the acquisition closes?
Well, he certainly tried to paint a positive picture, you're right. He really emphasized that the underlying demand for EGRIFTA SV is still, quote, very strong. He even talked about record-high patient enrollments.
Okay.
He did acknowledge that estimated $10 to $12 million negative hit from the shortage back in Q1, but stressed that the issue was resolved. He said unique patients are back to normal levels, and importantly, new patient signups are at record highs.
So underlying demand is still there, he argues.
That's the message. And he added that Trogarzo net sales have, quote, stabilized as expected. He said the company anticipates a return to our growth trajectory for the top and bottom lines in the coming quarters.
And wasn't there news about a new product version?
Yes, exactly. He highlighted EGRIFTA WREA. He called it a new and improved version of this important medication for people with HIV. And crucially, he said it's on track to bring to the market in the third quarter. The idea is to capitalize on that underlying demand momentum.
Right.
So, yeah, his message is basically recent numbers look a bit rough because of specific resolved issues, but the foundation is strong and we've got a new product coming.
Okay, that makes sense. Let's pivot then from sales and demand to where the company actually spent its money. Given the acquisition news and those revenue wobbles, where did the resources go? Any standout changes in their costs?
Definitely. Let's start with R&D expenses. They saw really significant decreases. We're talking 45% lower in Q2 2025 and 34% lower in the first half compared to last year.
Wow, 45% in Q2. That's a big cut. Why?
It mainly comes down to two strategic decisions. First, a, quote, reduction of spending in our oncology program. That signals a clear shift away from that longer-term, maybe higher-risk area. And second, just lower spending on the F8 formulation, which makes sense because it got FDA approval back in March 2025, so less development needed there.
Okay.
And it's worth noting, just as a detail, that the R&D expenses back in Q2 of 2024 included about $766,000 in accelerated depreciation for equipment after they decided to stop that early-stage oncology R&D.
Right. So it sounds like a deliberate move to focus, maybe trim some fat. Could that be appealing to an acquirer, perhaps?
Absolutely. That kind of cost discipline focusing on core assets often does appeal to a buyer looking for a leaner operation.
Okay. So R&D down sharply. What about the cost of actually selling these specialized drugs? Selling expenses up or down?
Selling expenses actually went up in both periods. They hit $6.84 million for Q2 and $13.3 million for the first half.
Oh, why was that?
The report says this increase is, quote, due in large part to higher compensation expense due to lower vacancies and hiring related to market preparation for the Ionis in-licensed products.
Ionis in-licensed products, remind me what those are.
Right, those are drugs where Theratechnologies got the rights from another company, Ionis Pharmaceuticals, to either develop or sell them. So they're gearing up for those.
Okay, so spending to support potential future products.
Seems like it. And the amortization of those commercialization rights is also included in that selling expense line, as usual.
Gotcha. And then the general and administrative side, the overhead costs, any big moves there?
G&A expenses also jumped up significantly, $5.48 million for Q2 and $9.71 million for the first half. That's compared to about $3.1 million and $6.8 million, respectively, last year.
Another big jump. What drove that? Was it also staffing?
Well, the main driver mentioned for Q2 2025 was actually professional fees. About $1.36 million of fees incurred specifically, quote, with respect to the sale process announced by the company on April 15, 2025.
Ah, so the cost of the acquisition itself showing up. Lawyers, bankers, accountants.
Exactly. A big chunk of that G&A increase is directly tied to the deal with Future Pak. Higher overall professional fees and also some stock-based compensation costs contributed to the increases too.
Okay. And just quickly, what about the actual cost of making the drugs? Cost of goods sold?
For Trogarzo, it's pretty straightforward. It's contractually set at 52% of net sales.
Okay.
For Igrifta SV, the cost for the first half was impacted by something specific. A $713,000 reversal of an inventory provision back in Q1.
A reversal of meaning,
Yeah, basically an inventory provision is when a company sets aside money because it thinks some of its inventory might become unusable or expire. This particular provision was recorded late last year for manufacturing batches of that F8 formulation before it got FDA approval.
well, so they were being cautious.
Right, and then once it was approved, they didn't need that provision anymore, so they reversed it, which effectively lowered the cost of goods sold for that period.
Got it. So lots of moving parts on the cost side, too. Let's get to the bottom line then. All these revenues, the supply issues, the shifting expenses, did Theratechnologies actually make money in this environment?
Well, no. The company recorded a net loss of $4.46 million for Q2 2025. That's a big swing from the almost $1 million profit they had in Q2 last year.
Ouch. And for the first half?
For the first half, the net loss was $4.35 million, which is also larger than the $3.5 million loss in the first half of 2024.
Okay, so net losses widened. What about that adjusted EBITDA figure we talked about earlier, the measure of operational cash flow?
Right, so adjusted EBITDA was positive for the fifth straight quarter, which is, good sign in one sense. But it decreased significantly. It was only $906,000 for Q2 2025 and $3.2 million for the first half. That's way down from $5.5 million and $5.2 million in the comparable periods last year.
And that decrease is mainly because of?
Primarily those higher G&A and selling expenses we just discussed, especially the deal costs, combined with the lower revenues from that Igrifta SV supply shortage hitting the top line.
Okay, so positive EBITDA, but shrinking. This raises a pretty important question then. How does the company's overall financial position look right now? Especially with an acquisition pending and these net losses, can they, keep the lights on?
It's a fair question. Management stated that they expect their existing cash, which was about $9.5 million at the end of May, plus the cash they generate from operations, should be enough to fund expenses and debt payments for at least the next 12 months.
So they feel okay for the next year. What about that going concern language? Sometimes you see auditors raise flags about that.
That's a key point. They specifically mentioned that a material uncertainty that raised substantial doubt about the company's ability to continue as a going concern was actually alleviated or removed, effective from the first quarter.
Ah, so that's good news. The auditors are less worried than they were.
Essentially, yes. Remember, going concern just means the auditors believe the company can likely stay in business for the foreseeable future, usually the next year. So removing that doubt is positive.
Okay, but is it completely resolved?
Well, there's a caveat. Continuing as a going concern still heavily relies on, quote, continued generation of revenues. And specifically, they mention a successful transition from Igrifta SV to Igrifta WR.
So the new product launch is critical.
Critically important, because they need those revenues to meet the adjusted EBITDA covenants in their credit agreements.
Covenants, those are the promises to lenders, right, about profitability levels.
Exactly. And failing to meet those covenants could potentially cause problems with their lenders, which in turn could even impede the acquisition closing. So there's still pressure there.
Okay. Any positive signs on the cash front?
Yes, actually. They reported positive cash flow from operating activities in the first half of 2025, about $2.7 million generated. That's a significant improvement from the first half of 2024 when they actually used cash in operations. So the core business, despite lower revenue, started generating cash again.
Right, that's important context. And speaking of things impacting stability, we mentioned the supply disruption hit revenue. Let's just circle back quickly. What exactly happened there and how did they fix it? Understanding that seems key to their current footing.
Absolutely. So that temporary supply disruption for Igrifta SV, it was formally announced back on January 9th, 2025.
Okay.
The root cause was an, quote, unexpected voluntary shutdown of their contract manufacturer's facility. This happened way back in the third quarter of 2024, apparently following an FDA inspection.
Ah, so a manufacturing partner had issues.
Correct. Think of it like their factory hitting pause to address some regulatory things. The good news is manufacturing did start up again in November 2024.
Okay, so production resumed, but they couldn't just start shipping again.
Not immediately. To get distribution flowing again, Theratechnologies had to file something called a prior approval supplement, or PAS, with the FDA. They filed that on December 18th, 2024.
A PAS. That's like getting FDA permission for a change.
Exactly. It's a formal application you need when you make a significant change to an approved drug or its manufacturing process. It ensures everything's still safe and effective.
And did they get it approved?
Yes, they did.
Yeah.
The FDA approved the PAS on April 7, 2025, and that allowed distribution to continue without needing any further authorization. So a big hurdle clear there.
Okay, good. So that supply chain headache, which definitely hurt revenue, is officially resolved. So looking beyond the numbers we've dissected and the problems now fixed, what are the key expectations and, maybe more importantly, the risks they're highlighting for the future, especially with this acquisition by Future Pak hanging in the balance?
Right. Well, from the source material, the key expectations they lay out are pretty clear. Successfully launching that new EGRIFTA WR in Q3 2025. That's huge. And obviously getting back to growth in sales for the existing EGRIFTA SV, the new EGRIFTA WR, and also Trogarzo.
Makes sense. And the risks. Acquisitions always have risks.
They do, and Theratechnologies highlights quite a few. Things like their ongoing ability to actually grow those sales, managing supply and demand now that's back online, ensuring the market actually accepts the new EGRIFTA WRR, and crucially, getting insurance companies to cover it. Obtaining reimbursement.
Standard pharma challenges,
Yeah,
right?
pretty standard, yeah. Plus, maintaining collaborations and agreements they have, dealing with competition from other drugs, and they even mention this sort of existential risk of a potential cure for HIV, which would obviously change their whole market.
Wow, okay.
And then very specifically tied to the current situation, meeting those credit agreement covenants we talked about, failure there could potentially impede the acquisition. Unforeseen safety or efficacy issues with their drugs is always a risk.
And the biggest risk of all right now.
And of course, the ultimate risk for the near term, the actual failure to close the transaction with the Future Pak, that deal falling through would be a major blow.
Definitely. So, wow, we've really peeled back the layers here, haven't we? It's clear how that temporary but pretty significant supply issue combined with strategic R&D cuts and then the very real costs tied to the acquisition itself, how all that shaped these financial results.
Yeah.
It's a complex picture all set against this backdrop of a massive ownership change.
It really is. And if you connect this to the bigger picture, this deep dive really shows how all these different factors, manufacturing hiccups, regulatory hurdles like the FDA PAS, strategic R&D choices, and then the complex dance of M&A, how they all converge to create this, intricate financial story.
Yeah.
And it also really highlights a balancing act a company like Theratechnologies have to perform, right? Managing the day-to-day operations while navigating and prepping for a huge transition like being acquired.
So thinking about what this means for you, the listener, well, it really shows that even when a company is on the brink of being bought, its underlying operational health and strategic decisions are still incredibly important.
Absolutely critical.
It also gives you a kind of practical framework for understanding why a company might suddenly pull its financial guidance and how looking at different expense lines like that jump in G&A can signal major strategic shifts or big corporate events like a sale process. So here's a final thought to leave you with. Considering those significant R&D cuts we discussed and the critical upcoming launch of EGRIFTA WR for HIV, how might this acquisition by Future Pak reshape the future path for developing and selling these essential medications? Especially now the supply issues are fixed, but regulatory factors like the Inflation Reduction Act continue to play a role in the background. It's definitely a story that's far from over.